Today, we're diving into a really interesting company, one that kind of breaks the mold in the industrial sector. It's called CSW Industrials. And what's so fascinating is that, according to this analyst report, it doesn't really act like a typical manufacturer. It acts more like a strategic compounding machine. It's a whole different playbook, and it makes you wonder, right, think about this for a second. What if an industrial company, instead of just making widgets, focused relentlessly on smart capital allocation? Buying up great businesses and plugging them into an already powerful platform. Well, that's pretty much the core idea behind CSW Industrials, and it's a strategy that really sets them apart. So what is this core idea that has analysts taking such a close look? Well, it really boils down to a powerful two-word strategy that pretty much defines everything they do. And here it is, the niche market compounder. Now I know, that sounds like a bit of jargon, but it's actually super important. It just means CSW finds these small, often overlooked markets, becomes the number one or number two player, and then uses all the profits from those winning positions to go out and systematically buy and build its empire. It's a fantastic flywheel for long-term growth. The entire case for CSW is really built on these 5 pillars. First, you've got the super defensive, kind of storm-proof business model and a really strong competitive fortress. Then you add the growth factor, a disciplined M&A engine, and seriously smart capital allocation. You put all that together, and what do you get? A top-tier, rock-solid financial profile. Let's break down how they pull it off. Okay, so it all starts with the foundation, which for CSW is a recurring revenue machine. This is what gives the company its defensive strength, and that's something every single long-term investor is looking for. And check this out, a massive 67%, 2/3 of the company's revenue comes from just one segment, contractor solutions. This is absolutely crucial, because this is the part of the business that sells essential consumable products to HVAC techs, plumbers, and electricians, the stuff they need every single day for maintenance and repair. And this slide gets right to the heart of the strategy. See, building brand new stuff is cyclical. It goes up and down with the economy. But maintenance, repair, and overhaul, or MRO, that spending is essential and stable. Think about it. All those millions of HVAC systems and industrial machines already out there have to be maintained, whether the economy is booming or busting. And that creates this beautifully predictable, recurring demand for what CSW sells. The best analogy I've heard is this. CSW sells the ink cartridges, not just the printer. The real, repeatable money isn't in the one-time sale. It's in the essential refills that keep that expensive equipment running day in and day out. That's the secret sauce to their sticky, predictable revenue. Okay, so a great business model is one thing, but it needs protection, right? So let's look at how CSW has built this competitive fortress, what investors call a moat, around its business to keep everyone else out. So how do they defend their turf? Well, this fortress is built on 4 massive pillars. First, you have these powerful brands like Rector Seal that pros have trusted for literally decades. Then there's their huge distribution network, which is super hard to replicate. Add to that their whole strategy of dominating specific niches. And maybe the most important piece of all, they make it really, really hard for customers to even think about switching. This quote from the report just nails it. It perfectly explains those switching costs. Why on earth would a professional risk a catastrophic failure on a $10,000 piece of equipment just to save a few bucks on a critical component? The answer is they won't. They're going to stick with the brand they know and trust. And that gives CSW incredible pricing power and insane customer loyalty. Now for the engine room. We've talked about this buy and build strategy, and for CSW, making acquisitions isn't just something they do on the side. No, it is the primary engine that is driving this whole company forward. And you can see that engine running in real time right here. In 2024, they made a series of these smart, smaller, bolt-on deals that just made their core business even stronger. But then, in 2025, they made a major move with Aspen Manufacturing, which showed everybody that they can play in the big leagues too. And to put that into perspective, the Aspen deal was worth over $313 million. A number that big sends a really clear signal to the market. It says that management isn't just making small tweaks. They have the financial firepower and the ambition to make huge, transformative moves. Now, all this sounds fantastic, but it leads us to the single most important question for any investor, right? The company is obviously excellent, but is the stock just too expensive? Let's dig into the valuation.
So if we look at a couple of common valuation metrics here, EV to EBITDA and the classic price to earnings ratio, the story is pretty clear. Compared to its peers, CSW trades at a noticeable premium. The market absolutely recognizes that this is a high-quality company, and it has priced it that way.
So why the premium? Well, the report argues that it's actually justified. Investors are paying up for a track record of superior growth, a really high return on invested capital, consistently over 10%, and a management team that has proven time and again that it knows exactly how to allocate capital. It's a classic case of paying a fair price for an absolutely excellent business. But hey, no investment is a sure thing, right? To be thorough, we have to look at the other side of the coin. What are the potential headwinds here? What could actually challenge this whole investment thesis? The report flags 3 key areas to keep an eye on. First, while their MRO business is defensive, it's not totally immune to a really severe economic downturn. Second, that M&A engine is a core strength, but just one bad deal, overpaying, or a messy integration could be really costly. And finally, you've got the usual suspects. Persistent inflation or supply chain chaos could squeeze their profit margins. And this really brings us to the final critical question for any potential investor. Buying CSW stock at this price is a bet. It's a bet on a superior business model and a proven management team. So the fundamental question you have to ask yourself is this: can this high-quality compounder keep executing its strategy and deliver the kind of growth that's needed to justify that premium price? That's the debate right at the heart of this story.